The sixth annual Investment Symposium is really all about letting our clients know about what's happening in the financial markets, but also what's happening at Marquette Associates, just importantly. They value and trust our advice. They value and trust the individuals that are consulting with them. And it's important for them to see how we're reinvesting in our business, how we're reinvesting in our technology, reinvesting in our people on a regular basis. So ultimately, they'll have a good experience. By staying relevant in front of our clients in an ever-changing investment landscape, they know that we're trying to do the right things long term for not only our firm, but also for their portfolio, for their board of trustees. And we think that aligns our interests very well with Marquette as well as our clients' interests. As Adam summed it up, it's really having a purpose. Why are we here? Why are we doing this? We have a lot of funds, endowment foundation funds that are doing good. We have pension funds that are creating, livelihoods for people after they've worked long years. So, as we go to these different meetings, it's really kind of important to see the returns that we generate are actually dollars, they're real dollars. And we talk about percentages all the time, but our clients view it more in terms of dollars and the impact that it can have, whether on individuals or on communities.
It was a real treat to be here with the Marquette team and your clients. And I was focusing on this so-called sharing economy, digital sharing economy, as one piece of a more complex new economy, new business models that fundamentally change how people and organizations meet their needs. And the sharing economy at its core is driven by three key principles that I focus on: resource utilization, decentralization through new technologies and peer-to-peer networks, and relationships. What does this mean for building community, social capital, and so forth? So this morning we explored a range of examples from around the world of sharing economy models, focused primarily on the three main asset categories where the sharing economy shows up. That is space, and that means homes and office space and retail space and so forth, but a lot of new platforms where people can share space more efficiently. Secondly is stuff, so we focused on transportation and healthcare and production and product development. Those were three examples. There are many more. And then the final one is skills. So space, stuff, and skills, otherwise known as the three S's. But skill sharing, which is new platforms for people to earn income in new ways, create livelihoods. We talked about the rise in the number of freelancers and independent workers. And so those were the examples that we focused on. Some platform examples here in the US and a few from elsewhere in the world. And then we wrapped up by talking about some of the policy issues that this new economy and these new business models trigger, as well as a little bit about what's happening around the world in other markets, from Korea to the Netherlands and so forth. And we also talked briefly about enablers of the sharing economy. So what does this mean for things like tax, insurance, some of those other issues, other themes that relate in some way to portfolio management? They do come into bear as we look at why and how these new business models might thrive.
So politics has been on a line of the minds of a lot of our investors over the last year or two, and that's really been driven by a lot of the surprising outcomes we've seen: the Brexit vote, the Trump election, the French presidential election. So we spent a little time this morning looking into those actions and then looking at the market reaction to those political outcomes. And I think the big takeaways for us really, A, these are very difficult events to predict. Even if you get the predictions right, the market outcomes can be surprising, even counterintuitive. And so as long-term institutional investors, we need to be wary of making too many investment decisions based on which way the political winds are blowing.
Some of the final takeaways and recommendations that we have for our clients is that, first and foremost, the Fed is going to be hiking rates and reducing their balance sheet, which is going to be a little bit of a tailwind for investment returns. Roughly 10 to 20 basis points for core bonds and bank loans, roughly 50 to 100 basis points for high yield and emerging markets debt. Now, we got to take that with a grain of salt because this is all based on statistical analysis. The second thing is the Fed is going to continue to be what appears to be very dovish, in the sense that they'll want to continue providing stimulative policies and stimulate the economy. And so they're probably going to be less prone to hike rates as much. They're probably going to be less prone to want to reduce the balance sheet as much. We also want to advocate maintaining your strategic allocations based on your organization's specific, unique target return, because it's very difficult to time politics. Of course, it's very difficult to time the markets. The other key takeaways are what can we control? We want to minimize fees. That's something we can very much control. And then lastly, to not put all our eggs in one basket and remain diversified.
So I talked about cryptocurrency and Bitcoin in particular. Bitcoin has been in the news an awful lot. 2017 has been up more than 500%. It's featured a lot of volatility, also awfully impressive returns. So what we wanted to do was talk about cryptocurrency, how cryptocurrency operates, and then spend some time talking about Bitcoin in particular, since that is the most common form of cryptocurrency. We looked at Bitcoin as an investment. It's awfully risky. It has very high returns, but the risk just makes it unsustainable as a long-term investment. In terms of looking to the future, we don't think the idea of Bitcoin as a future currency is dead, but as we look out long-term into the future, we still think the majority of transactions will be done in traditional currency and not any type of cryptocurrency.
Today, in this flash talk, we attempted to answer the question of whether it makes sense to have parity between your U.S. equity and international equity allocation. So to answer this question, we did several things in terms of analysis. We looked at historical returns going back as far as we could go, and we looked at both returns as well as risk. And we identified that historically, international equities have improved the overall risk return profile for a global equity portfolio. But we understand that where we are today can be very different than where we've been in the past, 20, 30 years ago. And there's some issues today where we need to take into account in projecting out to the future. So accounting for some of the issues like higher correlations, less diversification benefit, we looked out and did some future projections to identify what kind of changes may be occurring in terms of risk return profiles. And we saw that while the diversification benefit has been reduced to some extent, by diversifying our overall international equity portfolio, we can get back some of that diversification benefit. And we saw some pretty solid risk-adjusted returns.
The topic was really the Amazon effect, and I talked about a couple different broad topics, including basically debunking some of the negative headlines that are out there in the retail space. So, for example, a lot of the headlines are saying that the mall is dead, but the reality is it's not really dead, it's actually just changing, and change is something that the retail sector has gone through throughout its history. So, for example, there's lifestyle centers now which have replaced the power centers, and people are adapting. So there's something called the omni-channel, where consumers and companies are combining all the different mediums that are out there, like your phone and mobile app, and making everything into one integrated system, better for consumers overall. And as far as the headlines go that are out there, you look at store openings today, they're actually still positive despite what the headlines are saying. And another metric out there that the headlines are missing is that absorption is still positive. So there's a lot of demand for tenants. And so those are some of the themes I talked about, as well as some of the overall trends within e-commerce that are changing the way based on technology and consumer demands.
Today's talk was really about how any individual can create a sense of both purpose as well as impact within their role in almost any function, either professionally or personally. Every single one of us, I think, has a unique set of abilities as well as responsibility to leverage the places that we are, the people that we're spending time with, and the family members that we can be to both our colleagues and our kids, to use those positions to both make the best decisions possible for ourselves, for our families, and for our broader society. Today I shared a series of lessons. One of the first ones was that true self-discovery begins where your comfort zone ends. That it's only once you start to make yourself a little bit uncomfortable, surprisingly, that you have those periods of really significant growth and recognition of not just what you want to be, but who you want to be in your own mind as well as in the eyes of others. And the second idea that was shared was that we become our expectations. We are a product of the expectations that we set for ourselves, as well as we believe others hold us accountable to, and that manifests in many different ways, but it's an important piece of recognition. A third idea was that there are three forms of currency. There's one, money. A second is mastery, the acquisition of new ideas and skills. And the third one is meaning. How do we connect ourselves to a broader whole and bring value to others? One of the central tenets of today's talk was, thinking about how do we bring value to others? How do we, create meaningful relationships? And one of the biggest things that I've seen over the years is that first and foremost, it occurs through listening above speaking. I've said many times to many people that listening intensely is a far more valuable skill than speaking immensely. And it's incumbent upon every single individual, in particular as a steward of significant levels of capital, to have an ear, not just to the marketplace, but to those whose capital you are representing, And so be an active listener, not just an expert at all times. The second idea, which was shared, was this concept that every single person can be a 1 millimeter domino. I showed a video of a scientist essentially tipping over a 1 millimeter domino that's stacked up against 13 sequentially larger dominoes that fall, eventually a 100-pound block. And what the scientist shares is within 29 steps, that 1 millimeter domino would have toppled the Empire State Building. And it's this incredibly powerful idea that we can take small actions that become catalytic for large-scale change, and not to be paralyzed by this belief that I can't make the entire impact just myself, but to understand that every single large-scale movement, every single large-scale set of impacts that you can create, especially when it comes to capital allocation, starts with a small commitment to move in one direction and then rallying others to support that belief.